Hello and welcome guys to the next lecture, and one that gives us a head start for the remainder of this course. On many previous occasions you have heard me say that volume and price action are the backbone of this strategy. Or I've mentioned that if Elliott waves forecast the future market direction, price action and volume will confirm our wave analysis and therefore represent us with low risk trade entries and best possible trade exits. Volume and price action are also going to stop us from overtrading as a part of this strategy. You will only take trades which fit the criteria of our strategy. With that being said, let's dive in and study what is volume and price action and why Elliott waves require the use of volume and price action. Like any other technical indicator used in trading business to forecast future price, Elliott waves have their limitations too. The first limitation is that while there will be instances where you will be able to use the Elliott wave analysis to make profits over the larger time frames, there will also be many instances where price will go against your analysis and often leave you wondering what went wrong. This market behavior is once again linked to professional traders and how they want us to trade. Remember how we studied that during corrective phases, market prices are confined to certain price zone, especially in complex corrections. This is where professional traders are most active. During these retest of prices, they are creating indecision in markets. As a retail trader, our stop losses get hit during these congestion phases on both buy and sell side of the markets. Guys, the second limitation is that professional traders or market makers often run away with profits as retail traders are too scared to join in on the big moves while it is happening in the real time. This is especially true during extended 5-wave progressions such as wave 3, wave 5, wave A or wave C. Third limitation is that we often see our Elliott wave analysis proved wrong by the markets. What we think is the start of impulse wave after a correction could simply be another leg of the existing correction. Remember, I told you that Elliott wave principle is an art, and by no means it is a holy grail to trading. The reason I love Elliott waves is that they filter out the trading opportunities I might have in near future. But to test the efficiency of those trading opportunities, I rely on volumes and price action. Now that we've studied the limitations of Elliott wave analysis, this brings me to introduce the two most pure and real-time technical indicators any retail trader can have in their arsenal. So the simple truth is this, guys: regardless of whether you are scalping as a speculator in stocks, bonds, currencies or equities, or you are a trend, swing or position trader in these markets, or even investing for the longer term, the techniques you will discover in this strategy here are as valid as they were almost 100 years ago. The only benefit we have over trading in the past is that we have price action and volume on the same chart. Volumes in the price action leave traces of involvement of big players and their reaction to a particular price move. Higher the volume, more valid the current move. On the other side, price advancement on lower volumes can have various reasons, which we will study later. In forex markets, or also known as the largest financial markets, we are able to simply interpret our volumes on each pair using volume indicator listed in the indicators list on MT4 platform. The quality of data, however, will depend on several factors, not least whether the broker is subscribed directly to the interbank liquidity pool or directly using one of the expensive wholesale feeds. Nevertheless, a quality forex broker will normally provide a quality feed to you. It is proven historically that volumes in forex markets represent 90% true activity, so retail traders, according to me, who trade without considering associated volumes are merely gambling their money in forex markets. There will always be market manipulation in the spot forex markets. In many ways, it is the most widely manipulated of all markets. While it isn't perfect, I can guarantee you one thing, guys: you will considerably be more successful using it than not, and you will see why once we start to look at the charts themselves across all the markets. This brings me to introduce price action to you, which is simply defined as change in price over any candle and what it reveals about the market sentiment. Also, volumes without associated price action are meaningless and vice versa. This price action could be immediate or can be seen in the following candles of any trading entity. To me, a price chart with no volume is only one part of the story. Price does reveal market sentiment at a given and precise moment in time, but with so much market manipulation prevalent in so many markets, it makes no sense to ignore such a valuable tool which is provided free. Whilst price is a leading indicator in itself, it only reveals what has gone before, or from which we then interpret what is likely to happen next. Whilst we may be correct in our analysis, it is volume which can complete the picture for us, guys. In a manipulated market, volume reveals the truth behind price action. In a pure market, volume reveals the truth behind market sentiment. And I've taught you many times in this course that manipulation decreases as the time frame increases. This is where the closing price of any candle on a larger time frame and its volume reveal a picture that you do not want to miss. Let's look at a simple example to study what we have learned about volume and price action so far in this lecture. Before I end this lecture, I want to give you my own perspective on how I use elite waves and price action and volume together. I do not prioritize one indicator over the other. What this means is that I approach markets with a very open mind. When wave count is unclear, I allow volumes and price action to present trading opportunities to me, while I label my waves as the prices advance in both bull and bear markets. The only thing I avoid is what I've been teaching you since the beginning of this course, and that is trading over shorter time horizons, which to me are a shortcut to failure. This also brings an end to this lecture. Guys, please go through the summary of this lecture before we advance to the final lecture in part 1 of this course.